So the Federal Reserve is talking about a pivot with an impending rate cut, while everyone is also screaming a market crash is coming. But is this really the whole story or just a convenient narrative that people love to talk about? So what's really going on now? The Fed's not just playing defense against inflation, they're eyeing the job market as well, trying to dodge a spike in unemployment. With the economy still growing because of the government's debt binge, this isn't your typical recession. So get ready. The next few months could bring huge opportunities if you know what to pay attention to. Let's talk about this. All right, so let's take a minute and talk about a lot of the chit chatter in the mainstream media as well as in alternative media space in reference to the Fed rate cut and things that usually follow after it, according to previous episodes we've had in the economy. And so I want to just share some thoughts real quick and give you somewhat of a different narrative and try to look for some opportunities amongst all this chaos here, just because it doesn't always have to be just doom and gloom in a sense. So I want to take a minute, share some thoughts. So curious to get your thoughts. And if you guys want to hear more of these little short, quick takes where I give more of a deep dive analysis, then definitely make sure you hit the thumbs up button and subscribe so you'll be notified when I put a video out there so you'll never miss out. But sweet and simple, I want to just talk about the recent news by the Federal Reserve of an impending rate cut, which is commonly known as the pivot, as a lot of people call it, which has caused a lot of chit chat, a lot of talk, as I mentioned before, and speculation in the financial world. And many experts and commentators are quick to say that this move means the market is about to crash. Even I myself have mentioned that based upon previous events, it usually follows in some type of correction within a 100, 200, 3-day time frame there. But yet, is this really common sense, or are we missing something even bigger here? And so let's look at the numbers, look at the facts, and the reasons why this time might be different in order to make sense of all this. So I want to start by setting the stage a little bit and give more of the real story behind rate cuts as well as a market crash based upon previous events that we've been familiar with. And people usually say one easy thing. When the Fed lowers interest rates, it means the economy is in trouble and the market will crash. However, a closer look at the past shows that this isn't always the case. For instance, when the dot-com boom burst in the early 2000s, the Federal Reserve started to lower interest rates. And so it is true that the market kept going down, but it's important to remember that it was already falling before the Fed stepped in. And so during the housing crisis in 2008, this trend happened again. So this time the Fed cut rates after the market had already started to fall. And the factor in there's also been times when rate cuts did not cause a crash, which is very interesting to say the least. So when the Fed cuts rates in the middle of the 1990s, the market didn't crash. Instead, it soared. So over the next few years, the S&P gained of over 200%. And in the same way, when rates were lowered in 2019, the market went up sharply as well. So what does all this mean? It's very important to know why rate cuts happen. So a market crash isn't caused by a rate cut, it's caused by the state of the economy in general. And so the second point is, what's driving the pivot and why is the Fed doing this at this current moment? And it's my opinion that the Fed's current shift isn't just about keeping inflation in check, it's also about keeping unemployment from rising sharply, which Powell and his colleagues see as a bigger threat to the security of the economy overall. So historically speaking, the Federal Reserve has been more reactive than proactive. They have tended to move only after the market has already shown signs of trouble. And so this time, though, the Fed is trying to avoid a recession by changing monetary policy before unemployment goes through the roof. And so one important thing to keep in mind is that we are not in a recession right now, according to their figures. But even though all the fire alarms are going off all around the economy as a whole, because of our government's over-indebtedness, GDP growth still seems to remain steady, if not what some would say spectacular, and people are still spending a lot of money, even though the average Joe and Jane appear to be dialing back more and more because they're using their credit cards. So the Fed seems to be most worried about the job market as one of their key indicators. So the Federal Reserve is very aware of how quickly things can change. Even though unemployment rates are currently very low in comparison to where they're probably going to go, they're making changes to policy to avoid a sharp rise in unemployment that could throw the economy into complete chaos. So now that we know a little bit about what's going on, where the Fed stands at, how do you find opportunities? And then what's next beyond that? So since the Fed is about to lower rates, everyone is wondering where they should put their money to make the most of the changes that are coming. So the chance of an asset boom is one of the most important possibilities right now. It's possible that the drop in interest rates will lead to more investment in many areas, especially real estate, technology, as well as precious metals like gold, and sooner or later, silver. And so when it comes to real estate, especially multifamily properties, cheaper interest rates will make these assets more valuable because they cost less to finance. Also keep in mind that tech stocks, which have already shown that they can bounce back, are likely to benefit from easier borrowing as well, which will lead to even more gains. And then you got the speculative assets, which are Bitcoin and other cryptocurrencies, could also do well as buyers look for higher yield options in a world where interest rates are extremely low. And so to sum it up, lower interest rates equals more speculation, therefore the potential chance of higher asset prices in certain categories. So why things might be different this time, people often doubt the idea that this time is different, and they have good reason to believe so. There are, however, strong reasons to think that our situation is one of a kind. Since the financial crisis of 2008, new monetary tools have been introduced, such as quantitative easing, the BTFP, which is the banking escape hatch, that they introduced last year in 2023, which are two just to name a few. And those programs in and of themselves have completely changed how the economy works. So the Federal Reserve has a wider range of tools at its disposal and is more ready to step in quickly and firmly if they need to. So on top of that, the world economy is linked and leveraged more than ever. So in other words, choices about monetary policy have bigger effects, which makes it harder for normal market patterns to actually hold up. But it's not always a good way to find our way. Based on how the economy is right now, lowering interest rates might cause assets to go up in value rather than the market going down. So getting ready for the next step in the next few months, there could be a time of rapid growth across many types of assets. If investors put their money in the right places, they could gain from the extra money that will flow into these markets when markets actually go down. So the most important thing to remember is to stay informed and ready to act. Always make sure you keep some extra cash on the side, just because you never know when a fire sale might come about. Just look at Uncle Warren Buffett and what he's doing right now by making sure that he has hundreds of billions of dollars ready for the next fire sale. So eventually the Fed's turn marks the start of a new phase in the economic cycle. People who can adjust to these changes will be in a good position to take advantage of the changes that lie ahead. So once again, just trying to keep you informed as to what's going on, give you an alternative perspective on things. It doesn't have to be all doom and gloom, because there will be opportunities out there, but you got to know what you're looking for and how to strategize when your plan's in place. Once again, just share my 2 cents on things. Curious to hear what you think. If you found value in this video, as I mentioned, hit that thumbs up. Take a minute, share this, leave a comment down below so that I know that you're actually feeling and understanding what I'm trying to get across to you guys. And always get your weight up, because at the end of the day, after all the dust settles and the banking sector goes through what it goes through, having something real tangible that you can feel gives you the best shot at being able to recapitalize your own personal financial matters and rebuild after this transition. But anyway, catch you guys later. Curious to hear what you think. Leave a comment.